Assalamualaikum warahmatullahi wabarakatuh to our beloved FIN430 lecturer, Madam Nur Hafiza binti Muhammad Yusof. So today, me and my fellow teammate will be representing on our group project, which is Company Financial Ratio Analysis of EcoWorld Group Berhad. This assignment is mainly highlighting on the company background, the vertical analysis of the balance sheet and income statement of the company, the trend analysis, and the comparative analysis, which we compare EcoWorld Group Berhad against Grand Hoover Berhad. First of all, I will explain briefly on the company's background. EcoWorld Group Berhad is a real estate property developer which is listed in the main market and in the Bursa Malaysia Security Berhad. Its main business is carrying out property development in Malaysia, also outside Malaysia, such as United Kingdom, Sydney and Melbourne. Having started its first project in 2015, EcoWorld Group Berhad expanded rapidly through joint ventures and organic development. The company also has grown into one of the largest property development company in Malaysia, which they have 8,000 acres of land bank in Malaysia.
Now, let's move to the next part, which I will explain to you about the vertical analysis of the company in year 2018 and 2019. So, what is the vertical analysis? Vertical analysis is a tool of analysis of the financial statements. So, item on an income statement can be measured as a percentage of gross sale, which item on a balance sheet can be explained as a percentage of total asset, liabilities and equities. So from the income statement, we can conclude that the company's administrative expenses grew in ringgit Malaysia, but as a percentage of sale. This indicates that the new money invested in administrative expenses was not as effective as it was in 2018. The vertical analysis displays that company's cost of goods also spikes from 78% to 81%. With the vertical analysis, we can clearly and effectively see that the cost of goods sold and gross profit to EcoWorld companies is a major problem. Meanwhile, from the balance sheet, we can see that the company's account receivable decreased from 8 to 34% in year 2018 to 8.01% in year 2019. This implies that the company is able to recover bad debt expenses. Meanwhile, the item that increase are the inventories, amount of raw materials, work in progress, goods and finished goods. The vertical analysis also shows that company's account payable spiked from 6.48% for year 2018 to 8.16% in year 2019. That means the company is unable to pay off its payable account, including owing suppliers for item and services bought on credit. Okay, next, the company maintained its share capital for year 2018 and 2019. So in conclusion, EcoWorld company must improve in terms of account payable in order to make sure a good of company health. In the case of EcoWorld company, we can clearly see that big costs are a big reason why profit decline despite the robust growth of the company sale. It also reveals how important the vertical analysis that help to identifying the main pattern over time.
For EcoWorld Company Financial Ratio Analysis, which is trend analysis for the year 2018 until 2019, we can see that in 2019, the company has lower liquidity ratio relative to the year 2018 for current ratio, quick ratio, and net working capital. This means the company has less capability to pay its short-term obligation on time. Besides, the firm has no sufficient margin of safety due to the less amount of current asset than current liabilities. Next, for the leverage ratio, Eco Company has a good performance in leverage ratio, which is debt ratio and debt to equity ratio in 2019 compared to the year 2018. It indicates that the less of the company asset are financing by debt and the company has a lower financial risk. Besides, less amount of the company capital are from borrowing. For market ratio, the company has a good performance in 2019 for market ratio, which is earning per share and price earning ratio compared to the year 2018. It means the company has more earning that can offer to the investors for each share invested, and the investors willing to pay more money per ringgit of current earnings. Overall, Eco Company has a better market ratio in 2019 compared to the year 2018.
So the next ratio is the activity ratio. The first activity ratio is the inventory turnover. So you can see that in 2018, the firm has higher ETO comparing to the year 2019 at 12.11 times and 0.75 times respectively. This means the firm is ineffective in using its inventory to generate sales and holding excess as well as unproductive stocks. The next ratio is average collection period. The firm's ACP is also higher in 2019 comparing to 2018, showing that the firm is not good in managing its credit sales and less cash in hands. But lower average payment period of the firm in 2019 comparing to 2018 shows that the firm is able to repay its debts faster than the previous year. Next activity ratio is total asset turnover. The firm also has good TATO because the firm is able to utilize its overall assets and good in managing its assets because in 2019 the firm has higher total asset turnover at 0.23 comparing to the year 2018 at 0.21 times. Moving on is the profitability ratio. The first ratio is the gross profit margin, and in 2018 the firm had 21.69% and in 2019 the firm had 19.07%, showing poor results of the firm, indicating that the firm is unable to control its COGS and relative to its sales revenue. Next ratio is the operating profit margin. In 2018, the firm had 11.99% and in 2019, the firm had 9.17%. This is also showing a poor result and performance as the firm is unable to provide more return because the firm is unproductively managing its assets. Next ratio is the net profit margin. In 2018, the firm got 7.62% and in 2019 the firm got 8.26%. Next is the return on equity ratio. In 2018 the firm got 3.76% and in 2019 the firm had 4.48%, also indicating good performance. The last one is return on assets ratio. In 2018, the firm got 1.59% and in 2019, the firm got 1.90%. This is also showing a higher statistic and indicating good performance. So overall, the firm's NPM, ROE and ROA are all higher compared to the previous year in 2018, meaning that the firm is good and has better growth prospect and is able to generate net earnings to shareholders, also meaning earn more ringgit. and able to maximize the owner's wealth and give higher return for the owners of the firm, as well as able to control the cost in its operation, and meaning that the assets are productive and to provide more return.
Okay, next I will explain about the comparative analysis between EcoWork company and its competitors, that is Grant Hoover Berhad. So, what is comparative analysis? Comparative analysis is a method of analyzing our competitors and comparing our tools or our site performs in relation to the competition. Knowing what our competitors provide and not provide is always better than guessing on your own. Okay, firstly is liquidity ratio. Liquidity ratio is the ability of the company to use its current assets to meet its current liabilities at any point of time. Based on the chart above, it shows that the Grant Hoover Berhad has better performance than EcoWork company. This is because the Grant Hoover Berhad has better and higher quick ratio and current ratio than EcoWork company itself. It indicates that the Grant Hoover Berhad company have more capable and able to pay its short-term obligations. It also shows that the Grant Hoover Berhad is more liquidity than the EcoWork company itself. Okay, next we move to the activity ratio. Activity ratio measures how effectively company to generate revenue in the form of cash and sales by using assets, liabilities, and capitals. Based on this chart, Grant Hoover Berhad is more efficient than the EcoWork company, as in using its assets to generate sales and make payments in short period and faster time. However, Grant Hoover Berhad takes longer time to collect its account receivables. That indicates the company is take longer time to recover debt from the customer itself.
So next, I'm going to talk about leverage ratio. Leverage refers to borrowing capital or loan. Leverage ratio is normally used by firm to measure the level of debt in a firm. This will eventually tell us about the level of financial risk of the firm. So the first thing about leverage ratio is debt ratio. So comparing both companies, EcoWork Berhad and Grant Hoover Berhad, EcoWork Berhad has a higher debt ratio compared to Grant Hoover Berhad. This means that the company depends more on debt to finance their company and they are in high risk. So it is better that if the company aim for more favorable percentage of debt ratio, which is between 20% to 50%. As for debt to equity ratio, EcoWork Berhad also has higher ratio, which means that the company depends more on debt than equity to finance their operation. So as for the profitability ratio is normally used to measure the overall performance or the effectiveness of the management in managing the rate of profitability generated by sales. So the first thing is gross profit margin. Comparing both companies, EcoWork Berhad has higher gross profit margin compared to Grant Hoover Berhad. This means that EcoWork is able to generate more gross profit from its sales compared to Grant Hoover Berhad. As for the operating profit margin, EcoWork Berhad also has higher percentage of gross operating profit margin compared to Grant Hoover Berhad. This means that EcoWork Berhad is able to generate more operating profit with lower operating expenses. Lower operating profit margin means that the company has to bear higher operating expenses. So for the net profit margin, EcoWork Berhad also has higher net profit margin compared to Grant Hoover Berhad. This means that the company is able to generate more profit on every 1 ringgit of their sales. So for the return on equity, EcoWork Berhad has higher return on equity percentage compared to Grant Hoover Berhad. This means that equal shareholders are able to generate more return from every RM of their investment compared to Grand Hoover Berhad. So the last one is return on asset. Equal also has higher percentage of return on asset compared to Grand Hoover Berhad. This means that the company is able to generate more return or profit from every RM of their investment in asset. So the overall performance of Grand Hoover Berhad and Eco Berhad from leverage and profitability ratio shows that Grand Hoover Berhad has better performance in leverage ratio, while Eco Berhad has better performance in profitability ratio.
Next, we move on to the market ratio. As we know, market ratio is to determine the value share of the company. So, the investor will use this ratio to know which company offers the better return. So, based on this figure, we can see that both ratios show that Eco Berhad has the better performance, meaning that the company is able to offer more return for each share invested, and their investor more willing to pay ringgit of current earning compared to the Grand Hoover Berhad. In conclusion, we can see that Eco Berhad ratio analysis outcome is not favorable. This is because based on their financial ratio, we notice that they have a severe issue that the company must concentrate on to improve their performance. However, the company is able to offer higher return compared to their competitors. Next, on 14 August 2019, Capital Asset Berhad issued RM250,000 medium-term note. So, EcoWorld Capital Asset will use the proceeds of the issuance for general corporate purpose and to refinance any existing or future financing of the EcoWorld. It indicates that the company trying to use less debt to finance their asset and to minimize their financial risk. So this is the reason why this company have lower debt ratio in 2019 compared to the previous year. Next, with a high percentage of debt ratio, this company is able to minimize their average payment period, which indicates that they are more efficient in paying debt. However, the average collection period is worrying as it hikes up drastically. The company also have a good overall asset turnover because the company can make good use of its overall asset and management of its asset. But in June 2019, EcoWorld profit slid, and this is the real reason why their profit is affected because of the higher administrative, marketing costs and sales. This is also the reason why they use their inventory not effectively to generate sale, to hold incentive, and to manage their credit sale and cash in hand. Last but not least, EcoWorld Berhad should continue its efforts to implement best practice in development and to show how sustainability benefits companies, stakeholders, and the environment.
Last but not least, for the recommendation, EcoWorld Group Berhad is a very high potential company which I believe they will be able to compete with well-known or well-established organizations for the future. The reason of me saying that is because their revenue has increased from RM148.4 million in 2014 to a number of RM2.55 billion in 2016. Although their revenue is quite encouraging, but the investor or the future investor need to hold and do not make a harsh decision. This is because property development has a problem of oversupply in the main cities such as Kuala Lumpur. On top of that, EcoWorld Group Berhad is also facing some difficulty in managing their liquidity and asset. This is because they use more credit compared to cash. Last but not least, the company is also struggling on overcome their debt. This is because they are still new in the market. The company has slightly lower ability to meet their short-term obligation, which will affect the current shareholder. So that's all from me and my teammate. Thank you for your kind attention. Assalamualaikum warahmatullahi wabarakatuh.